Zacks rank buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks rank buys. Specialty software and a technology company top this week's aggressive growth stock picks. Bill Wilton here to elaborate on them for us. Kenexa Corporation is that specialty software company, KNXA, the ticker. You've written about this company before, right?
Yeah. What they do is a lot of HR type solutions that help companies recruit, retain, evaluate employees and really get the most out of them. Their most recent quarterly report was back on November 2nd. It was a great quarter for them. Their top line was up about 53%, which was fantastic to see. Revenues came in just over $77 million. Which you might not think in a time where the employment market is so tough. But they did beat expectations on the bottom line as well, coming in at 17 cents a share, 2 cents better than expected, and also raised guidance. You know, a lot of times we look for three main things in an earnings report: top line, bottom line, and the guidance. They hit all three. So investors were very pleased with that. Analysts went ahead and started raising estimates. That's what pushed them up to a Zacks #1 rank. They're now expected to grow about 34% this year, another 39% next year. So that's solid, consistent growth out of them. One main concern here, though, is that their valuations are getting kind of lofty. So, you know, some people might want to wait for a pullback. As we're seeing in the chart, you know, that's already starting to happen. So there's a bit of a concern about the momentum here. But, you know, once this slide stops, that really could be a good potential buy, you know, a buy on the dip candidate. If people are looking to bottom fish.
Well, they've been involved in some M&A activity over the past week too, right?
Yeah, they just bought another similar company that focuses on the hospitality sector for just under $12 million in cash. And they also entered a 5-year deal with Eli Lilly, which should bring in some very solid revenue growth for them over the coming years.
So those are good things for them.
Definitely.
Okay. Hollysys Automation Technologies is that technology company. They make automation systems.
Yeah, they're in several different markets: railway, industrial, and nuclear, amongst others. They do operate in China, which does give some people reason to hesitate because we've seen a lot of stories come out of that region. But so far, so good with these guys. They just reported what management called a stellar quarter on November 14th. Their revenues were up 43%. The bottom line increased 23%, came in ahead of expectations. They also just wrapped up a share buyback program. They spent about $7.5 million on 1.25 million shares. So that's a little less dilution than we're seeing. On the bottom line, unlike the previous company, they do have much more attractive valuations. We're looking at a PE ratio just under 10 times the forward estimates. That gives them a PEG ratio at 0.7. Usually with those PEG ratios, you're looking at 1.0 is a good indicator of a value. So it looks like we're getting those growth rates at a nice discount here. As far as the chart goes, they have been hitting a bit of a sticking point lately. That's not uncommon in a hesitant market for a share that's run up this much, but it has been fairly resilient relative to most other stocks that are in this point, and you can attribute some of that to the momentum, but also those already low valuations.
All right, do you own either one of these two?
I do not.
If you haven't gotten over to our website yet and you're not watching this video from the website, you may want to get over to Zacks.com and check out some of the other stock picks that we put up there for you each business day. 4 new ones each business day. With Bill, I'm Terry Ruffalo.